Its 31st Monetary Policy Committee meeting held on July 21st and 22nd, 2025, the Central Bank of Nigeria, CBN, opted to maintain the monetary policy rate at 27.5%, keeping other parameters, cash reserve ratio, liquidity ratio, and asymmetric corridor unchanged. This decision comes as the Naira hovers around 1,555 Naira to the dollar in the parallel market, with analysts predicting continued caution given persistent inflationary pressures and exchange rate volatility. We have now joining us the CEO of Finance with Muktar Mohammed. It's great to have you in. All right, if you can briefly unmute your mic, I'm sure we can progress with the conversation. We've had 3 consecutive holds, right, on interest rates from the MPC committee. They've made that decision twice. And there's some who are beginning to question now, is this a situation of analysis paralysis where the safest thing to do with all the data is just to stand still than to make a decisive decision? What are your thoughts on this?
Well, sometimes we have to ask ourselves where we are coming from. For the past over almost 18 months, we were hiking rates. And that became the normal. But now, what we are getting from them is that most of them are looking at bringing down rates, which is something that should be done with caution. Maybe that's why you are seeing those cautious approach from the CBN. But like you rightly pointed out in your report, also a lot of issues are on ground that need to be addressed before you begin to bring down rate or tickle with whatever you have now. What we have is a fragile inflationary downtime. What I mean, inflationary down data, because it's very fragile. The exchange rate, like you said in your report, is still hovering between 130, 150, 500 and 1,530, 1,550. So oil output has improved, but has not into the budget benchmark yet to end in a lot of inflow. And also, you still have the external shocks that you have no control over. And like I said, the external shock that you have no control over. And also, we are still dealing with a lot of security issues in area of movement from one point of Nigeria to another. So all these are issues they need to deal with. And so I think what they are doing now is, like you said in your right, is the cautious approach, despite some good data from the Nigerian Bureau of Statistics, some improvement in terms of ease of doing business, in terms of price of commodities. But I think cautious is the watchword that the CBN is doing at the moment, and I think it's a good approach. If you look at the fixed income space, you could see where we are going to be heading towards in the near time, because you see rates has come down in that space also.
Mm-hmm. Obviously, it was a data-driven decision from what we're hearing, and like you said, caution has been the watchword. But coming to the data now, we know that there have been a number of shifts in the way a number of our data points are being calculated with the rebasing exercise. So how would you say that the recent CPI rebasing perhaps has affected the interpretation and management of inflation by the CBN?
Well, I have said it on your program. It's rebasing does not put food on your table. Rebasing might bring down inflation rebasing may bring down inflation, but yet rebasing will not bring down inflation to reality. So what I mean is that by rebasing, you are bringing in a new product, you are bringing in refinery, you are bringing in pension funds, you are bringing in a lot of these data that were not captured in the previous rebasing, and then you bring it in. But again, where it begins to make impact is where you begin to get investment, either in foreign direct investment or foreign portfolio investment, or these data are now creating new jobs, and these new jobs is now bringing and making Nigerians to earn more, and also help in terms of driving price of goods and services down. That's when you begin to see this rebasing policy have really helped inflation pressure. But as it stands now, it's just a way of saying there are new areas that you can invest in, And you know that our inflation pressure is largely driven by the exchange rate volatility. So what it means is that you can't use this new area to attract new inflow either by foreign portfolio investors, and that will help stabilize your exchange rate, and that will help bring down inflation in the long run. That's what this rebasing is doing. But rebasing itself is not a tool to bring down inflation.
Yeah, indeed. And sticking with MPC decision yesterday, we know that aside from maintaining MPR, the CBN also maintained the asymmetric corridor, they maintained CRR alongside liquidity ratio. Why do you think this was done? What would you say have informed such decisions?
Remember, we are still having the banking recapitalization. We are still having a lot of liquidity. One of the ways that the CBN deals with inflation is reduction in liquidity in the system. Unfortunately, the most vibrant sector in the Nigerian economy is the informal sector, and it's largely driven by liquidity. So it's still a challenge. I think that's why the CBN is still leaving those rates as it is, even if it's going to have an impact on the informal sector in the short term. I totally agree with that. Trying to use that as a tool, especially with the kind of inflow that we are getting into the Nigerian economy. And some of this inflow, you know, that are not captured also in the formal economy. So that is the big challenge. Or the liquidity that is outside the central bank previous are still very high. So I think that's what they are trying to deal with. But it has its consequences, like I've said. It's affecting the informal sector in the short run. I think they are looking at dealing with the monster inflation and looking at growth. For now, they want to deal with inflation. They want to deal with exchange rate. Once you deal with inflation and you deal with exchange rate, automatically you experience growth.
Yeah, we'll be monitoring their efforts. And finally, I mean, to tie things together, again, 3 consecutive holds from the MPC. What would you say are the potential risks of leaving interest rates at such high levels? And hopefully we don't have another hold. Who knows what will happen and what will inform their decision. But yeah, what would you say are the risks with holding interest rates for a prolonged period of time?
Cost of funding for businesses. You've seen that, again, a lot of businesses will be borrowing at a high interest rate. Non-performing loans may also increase because, again, some of these businesses that will borrow from these banks will not be able to pay. So those are the main 2 critical issues that happens when you hold rate for this long. And I think we've been doing that for a long time. Cost of borrowing, which is key to the drive of the formal sector, especially, and even the informal sector, MSS, also SMEs, also, they've not been able to expand because of the cost of funding. And some of them, again, most of their chunk of their profit are gone towards servicing some of these loans at a high interest rate. So they are also not able to expand, and they are also not able to employ a lot of Nigerians to drive growth in their business. I think those are the 2 main critical things that affect when you put interest rate this high. Expansion is limited, and also cost of funding is very, very high.
Muktar Mohammed, CEO of Finance with Muktar, thank you for sharing your thoughts.